Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, New York City, we have Mish Schneider, Director of Trading Education over at MarketGauge. Mish, it is great to finally meet you in person, have you at market site. Welcome. And the billion-dollar question is, and if we all knew this answer, we wouldn't be working, right? Is, inflation, that core PPI coming in just a touch, is it enough to tame the markets?
No. Clearly what we saw today was a lot of hopefulness that it would be enough to tame the market, because there are pockets that actually went up. The retail sector went a little green, the biotech sector went a little green, but still if you look at the indices, they're having a lot of trouble. And I believe that the inflation has to be where you look. If you're going to look at things like used car sales and some of the ones that you knew ultimately would get softer, that's one thing. But if you look at food prices and energy prices, there's nothing soft about what's going on there. And with grain prices in particular, we just had a new onburst of fires in California, New Mexico, where I'm from, on fire all over the place, and drought has really hit the plains. So we could really be in for more pain driven by this food inflation factor.
What is the bond market telling you?
Well, what's so interesting about the bond market is for the last 10 months, it's been in a serious downtrend. That's because yields have gone up and the yield curve is inverted. But right now, on Monday in particular, when the market took that deep dive over 1,000 points lower, the bonds actually flipped around and closed in the green. So that's telling me that a couple of things. One is that it's possible that we're getting a new flight to safety in bonds, which would be really interesting, right? Considering the whole thing is that the Fed's supposed to be hawkish. And two, it could mean that the credibility of the Fed being able to maintain a hawkish stance in the face of killing not only the market, but potentially the economy. The jobless claims actually went up. They look at labor very carefully, is also a factor, in which case it won't be great for the market.
So equities are down, bonds are down, crypto is in panic mode. The US dollar is up, is not necessarily what you want to see either, and you think it could be a Bretton Woods type of event.
Well, back in the 60s, Brentwood was a conference, and what basically they did was, they being a bunch of central banks, was that they were actually selling the gold to keep it from inflating, and they were buying the British pound. And this worked out well because in the beginning, they actually were buying the gold and selling the British pound because they were just following technical analysis. When they flipped to the fundamentals, they were actually buying the British pound as it was collapsing and selling the gold as it was rising. And so the whole thing got disbanded in '68. Fast forward to today, the central banks are in a very concerted effort buying the US dollar for a host of reasons and selling the gold for the same reason. So you have to wonder at what point does that rubber band get stretched, where the dollar gets too strong and the gold relative to what's happening in inflation gets too weak.
And you're also comparing China to perhaps performance in 2008. It's so interesting. It seems as if they've been through some pain, and could they potentially recover a little bit quicker than we do? But we've got to open up, not just for our supply chain, but it's going to impact their economy.
And that could be the last thing that we're waiting for to really see the 2008 scenario replay. In October 2008, China FXI bottomed while the US was just starting its major decline. Now, of course, we were already having a major decline, but China bottomed again in March 2022 and has gone down with the market, but is holding up and is actually closed in the green even in the last several days. So it's possible that their monetary policy, which actually was ahead of ours, they tightened last year, easing this year with the new restrictions on COVID, but they're easing up on tech. They're starting to realize maybe they came a little bit too heavy-handed with Alibaba and JD.com. And now once China opens back up again, it could really be a great scenario where not only the actual index goes up in some of those companies, but relative to the performance of the US, it starts to outperform.
I want to wrap up and talk about commodities, and you had mentioned the drought fires and the wind out west in the plains is really the catalyst there. As you trade that, I know you use DBA as a vehicle, how do you position with that?
Well, we've been long wheat and we were long DBA. We're going to get back in again. We were in it for a long time, and we're looking at some of the other sort of grain commodities as well, but actually also focused very much on sugar. Sugar is interesting because it's tied to a little bit of an inflation. It is a food, obviously, in everything, as we know. And on top of that, it has a nice correction into support, but it also is tied to oil. So essentially, to me right now, sugar might be the best buy out there in terms of a commodity. Gold and silver have just collapsed with the rates and with the dollar, and I don't know what's going to necessarily be the catalyst to make it go up, but we're flat in the metals and mostly interested in the softs and grains.
So how are you positioned here? Are you waiting for a capitulation point, or are you thinking about putting some cash to work? There are some good deals out there with good companies with nice cash flow trading at low multiples now.
Exactly, but that doesn't mean they couldn't get cheaper. I'm looking at things like Microsoft. If Microsoft went to 140, I think that would be really compelling. If Apple, which is also declining, got down closer to 100, might be really compelling. But I think the thing that people have to remember is we're traders. Not that we're active day traders, but we like to hold to a position for a week to, say, several months. These companies may actually bottom out, but they may not really yield great returns. Like, you're not going to necessarily see Apple go from 100 to 200 like we're used to. It could be 100 to 125, 140 where it broke down from, and sit there for a long time before the passive investors see any real growth.
So you head up trading education over at MarketGauge. There are, especially younger traders, we saw the influx of retail traders in 2020, 2021, and the mentality has always been buy the dip because the Fed is in the market buying securities. How are you helping them manage it now?
Well, I've really been trying to get them to focus on things like momentum and moving averages and price breakdown. Somewhat of a macro understanding. Clearly, after 40 years of an accommodative Fed ending, that has to tell you something when everything has been so highly overvalued. The PE ratios that people don't even think about were at record highs, along with inflation, along with our debt that's based on over $137 trillion of the GDP. I mean, these are the things you have to wonder and say, is this sustainable? So big picture, but then from a technical standpoint, at least get some idea of a chart and realize that until you actually see a real capitulation, which I'd say a V bottom could be at least some kind of sense, which means you make a sharp move down like we're seeing. Some of these are trying to make a sharp move up, but it's got to sustain for a couple of days. And then if you have a good risk point, think more actively and get out if you're wrong quickly and take profits along the way. And I think those are probably the best lessons.
Yeah, all right, Mish, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.